The price rate of change, ROC, represents a momentum oscillator measuring the speed of which the price is changing within the defined time period. The rate of the change calculates to the percentage change between the most recent price and the price registered a certain number of the previous periods ago. The most forms an oscillator moving above and below the zero line as the rate of the change moves from the position to the negative. So the ROC indicator is plotted against zero with the indicator moving upwards into the positive theory if the price change are the upside and moving into the negative trilogy if the price change are the downside, like another momentum indicator, stochastic oscillator, for example. ROC can be imprinted in numerous ways. Trades using this oscillator for the overbought, oversold signals, divergence and zero line crossover. A value above the zero indicates an increase in a bullish momentum, and the negative value suggests an increase in a downwards momentum. Rising ROC typically confirms that the uptrends, but this can be misleading as the indicator is only comparing the current price to the price and period ago. Falling ROC indicators the current price is below the price and periods ago. This usually helps confirming downtrends, but it actually occurs when the price consolidating. The ROC will hover near zero. In this case, it is important traders watch overall price trends since the ROC will remove little in slight expect for the confirming slight way movement. Overbought and oversold levels are not fixed and ROC, and each asset will generate its own extreme levels. Traders can see what these levels are by looking at the past reading and observing the examples level of the ROC researches before the price reserves. All markets can work well with the ROC indicators. There are no right or wrong settings to use, but every trader has to make decisions depending on the market conditions and the volatility of the financial markets. The ROC indicators can be used on the various time frames. It can be used for short term trading, but in general the value of the ROC indicator is better used for identify the long-term trend. There are various settings that can be used for the ROC oscillator. The common settings used for the indicator is 9 periods. Other commonly used settings include 14, 21 and level 50. Remember that there is no absolute number that can magically give you right settings. Rather, it is important to analyze the behavior of the stocks or currency you are trading in order to use the right or the most appropriate settings for the price ROC oscillator. The volatility of the market being analyzed is of course of utmost importance. Using too small a number like the 9, for example, can lead a very choppy readings, while using the higher conversion settings would probably lag their work to the point that the signals can be very delayed. If we take a look at this market, you can see that when using the 5 period settings for the oscillator, the ROC can be the choppy, while it might look easy in the hindsight. It is important to note that the oscillator will have problems to pick up the tops and bottoms, or in other words, rising and failing momentum in price. So you need to find the right balance and situated for the markets you are trading and the time frame you are mainly using. How to trade with the price rate of the change first strategy using the ROC indicators as the timing tool. Within the trend analysis, we already know that price never moves to the straight line. The two prices post the several of the heights and the lows within the trend. The challenge is of course of the buying near the low point or the dip in the uptrend, or the selling near the high point or the rally in the downtrend. The ROC indicator can help you to define these points. Trends can be analyzed easier by looking at the highs and the lows, or looking for the signals from the technical indicators such as moving average. In the first approach of the using ROC to analyze the market, let's look at the simple setup that involves one moving average and the ROC. Now, maybe the most common way to trade use the ROC oscillator is entering the market when the plotted line cross the zero line, breakout in easier direction indicates increasing decreasing momentum by itself. This signal is not reliable because sometimes the ROC can't dip below the zero line only to resume back higher. And this again important point to know: the ROC reacts to the piece and do not other way around. Therefore you need to focus on the price and the price actions as well before trading this. Simple methods: with the ROC indicator we can improve the zero line crossover approach when they combine the price rates of changing with a trend indicator, as we can observe in the example. When used the combination with the moving average, the ROC offers several entries in the markets when the line cross below the zero line. As most of the oscillators, the range of the change works well is trending scenario. The first step to determining the prevalence trend to the market, you can use the classic moving average 50, 100 or 200. In this example, I opened for the 50 period simple moving average. When the price trades above the 50 period simple moving average, considering token my long entries, and when the price trades below the 50 period SMA, search for the support entries when your monitor the rate of the change indicator and take as the zero line a crossover. Only in the confirmation with the 50 period moving average consider exiting your position when the slope of the rate of the change trust in the observation directions. Here's some example of the zero line crossover confirmed by the moving average. The second strategy involves using the ROC or for divergence. The correct of the divergence is the same whatever you are using the relative strength index RSI in the stochastic or the price of the change. And diverge is in common to oscillator. When the oscillator forms the fresh low but price does not, or when the price forms a high but the oscillator does not, it can indicate a possible diverge and the signals to the corrections. Using this knowledge, you can apply the price rates of change and look for the divergence with the price. So divergence occurs when the price for the stocks or another asset moves into directions while its ROC moves into the opposite directions. For example, if the stock's price is rising over the period of the time while the ROC is progressively moving lower, then the ROC is the indicating bearish divergence for price, which signals a positive trends change to the downside. The same concept appears if the price is moving down to the rock is the moving higher. This could signal a price move to the upside, and divergence is leading signal but could provide to be not ordinarily poor timing signals, since the divergence can last a long time and won't always result in the price reserves. Timing divergence is maybe even more important than the spawning the pattern. This example shows the rock indicator positions a long-term divergence. There's several peaks for the rock reading, and all of them would have given the wood wrong trading signals. One method to time to the divergence and filter the bad signals is to wait for the trend line breakout for the chart. Also, you could wait to the price rate of the chart to cross below the zero level. In this example, we can see the instead of the divergence that the forming. There is the price posted a lower low, but the rock oscillator posted the higher low. This divergence, known as the bullish divergence, can be used in two ways. You can go long the market after the trading line breakout and after the rock indicator crossover above zero indicator a bullish momentum. The third approach involves overbought and oversold conditions. These levels are not fixed but will vary depend on the market being traded. Traders look for to see what rock values result in the price reverberations is the best in the past. They will try to find both positive and negative values where the price reserves with the sum regularly in the past. When the rock reach the extreme reading again, they will watch for the price and start reserving to confirm the rock signal. Honestly, I don't like this approach at all. This strategy might work in the non-trending market, but during strong trends often get false signals, as shown in the example. As I said before, the rock shows reading at the extreme value, but it has no boundaries. In a very strong uptrend, the rock oscillator could show reading outside the usual range within the specific time period. These overbought or oversold extremes could be moving as they could indicate the trend reserve, but this extreme value are the highly subjective, so I wouldn't contrast my attention on the overbought or oversold levels. Another potential problem with this using the rock indicators is that the calculation gives the equal weight of the most recent price and the price formed a number of the periods ago, despite the fact that some trades consider more recent price actions to be more important, so they determine like your future price movements. This can result in the multiple false signals to the trend of the trades. That's why it's important to keep an eye on the price actions and which market slides, and always look for the big picture, your multiple time frames, to increase your odds of trading in the right directions. As always, if you learned something you found valuable, leave us a like to show your support, subscribe to our channel and hit the bell icon to stay notified when we upload next video. Until next time.